So now let's look at the Rostock. I'll just explain the 1 to 3 again on this one to make sure it's really clear, because that's actually an important thing that you understand, that you don't just see the pattern on the chart and think, wow, that's a 1 to 3 high, but that you understand why it appears there and what it actually means. So on this example, as you can see, prices strongly move up, and at some point they started to go down and drop for 3 bars. For whatever reason, people take profit, sell, prices move to 0.2, making that low here. Now buyers come in again, price moves up towards 0.3, and somewhere here something really important happens. And what happens is that prices stop moving higher than 0.1, meaning we don't get a higher high, but instead get a lower high at this point, causing number 3. And this actually will cause a lot of people trouble who bought down there, and make other people wonder what they should do with their position if they are in for the trend for the long term, because of course this will disappoint them to see that happening. What they want to see is prices move above 0.1 and continue the trend, but what happens is it doesn't. And of course, here we've got a lot of potential for people who are in a trade to get out of the trade, or for other people to go short. And this is what causes actually a 1 to 3 formation, and what also makes it very powerful, because you've got that change in the supply demand equation. This is exactly where it happens. Okay, let's look at Rostock. Rostock is simply created by the first failure of prices to continue in the direction where they were moving. In other words, it's quite the same as a 0.1 actually. You see, here we have the Rostock, here's the Rostock, then price moves up again, fails to move higher, and when this happens, when this bar closes, we've got a Rostock. Same up here, this 0.1 also basically, it is a Rostock. Then we got the 1 to 3 formation, price moves lower up to this point, then it stops moving lower and does a correction, and then we got a Rostock here. Yep, a Rostock is also created after prices fail to make a new high, after a breakout of a ledge, for example. Can also be a consolidation, or as I already said, a 1 to 3 high or low. Here we got a consolidation. I'll explain later on what a consolidation and what a ledge is and where the difference is. But again, this is another example. Price breaks out, stops moving lower, and then we actually got a Rostock. So now let's look at consolidations. There's a difference between a ledge and a consolidation. As I said, a ledge cannot consist of more than 10 bars, but a consolidation starts at 11 to 20 bars. So, for example, here we'd have a consolidation. You can see we've got that move up, and then actually prices start to move sideways, meaning they stay in this range, consolidating and not cannot move out of this. A trading range actually is a consolidation that has more than 21 bars, as you can see in this example. So if you get more than 20 bars, it's no longer consolidation but a trading range, and those can last for quite a time usually. But prices tend to break out between 21 and 29 bars. Depends on on a daily chart, I'd say yeah, that's true. But on a 5-minute chart, for example, price can consolidate a lot longer, 21 to 29 hours. So you can see the euro. What we had here, for example, actually is a trading range, meaning prices moved more or less nowhere, up and down a bit. So here we got a breakout of the consolidation, meaning we got a raw hook. Then what happened here is prices moved down, and here we had a correction. And during that day, price could not move lower than on this day. And from that point on, we actually had a raw hook. And we didn't talk about traders' trick entries yet, but some of you already know it. So at this point, we'd have had an entry, the trader's trick entry. We mark that. And prices moved down nicely, almost down to 26. And seems to be moving up now a bit. So if you would get a bar tomorrow, see if I can do that. Nope. That maybe looks like that. We would have another raw hook, meaning if tomorrow's low is not lower than today's low, that would create another raw hook. So just follow cross action, correct? Yeah, I just use price action, high-low chart, and as I said before, there really is no difference. If we look at it would be a bar chart, and that's a candlestick chart. It really shows the same thing, and actually we could even look at, we could even look at high-low charts without the open and close, because it doesn't matter when trading with the trader's trick entry using raw hooks and 1 to 3 formations. Is raw hook a swing? No, actually not. A raw hook is, you could say, it's the end of a swing. Meaning if you'd say that we've got here a swing, now if tomorrow prices actually make a higher low, then we would have a raw hook down here. So you could say it's the end of a swing. It's the point where on a chart, the low on a chart, where prices cannot move any lower and start to do a correction, which is also potential point 1. Okay, so as you can see, it really doesn't matter if you use a bar chart or a candlestick chart. Of course, if you're used to candlesticks, you can use those, but trading the law of charts, we don't pay much attention, at least I don't, to where the open and close on a specific price bar is. Especially in the Forex market, that's quite, it doesn't have a lot of meaning. I mean, on a daily chart, for example, if you take some commodity futures, back in the days when they only traded for a couple of hours, actually the open and close did matter. It had a completely different meaning. Same for stocks, but in the Forex market that trade 24 hours a day, I can hardly see any meaning for open and close on a daily chart. Quite accidental. Whether it's there or there, I mean, it's just a specific point in time where you say that bar now closes that. It doesn't matter much to me.